Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're going to look at interest rates. The Bank of England has cut interest rates to 0.25%, the first move in more than 7 years. What does it mean for your investments? Let's get started and kick off with Senior Editor Emma Wall and Chief Investment Officer for EMEA's Morningstar Investment Management, Dan Kemp, who discussed the implications of this rate cut to investors' portfolios.
Hi Dan.
Hi Emma.
So we've just had an announcement from the Bank of England. They have cut rates to 0.25%. They've issued some QE and there's a new sort of funding for lending scheme. I thought we perhaps could go through the asset classes and see what it really means for investors, starting with bonds.
Yes.
60 billion gilt purchase to come and a 10 billion corporate bond purchase as well in order to help boost asset classes.
Yes, so this is a heroic attempt by the Bank of England to make some of the most expensive asset classes in the world even more expensive. And all it's really going to do is bring forward future returns to the present. We hate to see investors pay too much for returns, and really we're just seeing an encouragement of that, unfortunately, from the bank this afternoon.
And this, of course, means that yields will drop. And we've heard from the Bank of England the forecast for inflation by the end of 2017, 2.5%. So it means for a lot of bond holders, negative real rate of return.
Well, that's exactly what we're expecting, and that's the worry, that you really are losing money, almost in nominal terms now, but certainly in real terms, by holding these assets. And so our argument would be that in many cases, investors are paying far too much for the safety blanket of feeling they own a low-risk investment. In reality, risk is a function of price, and they need to be thinking about how much they're paying for these negative returns.
Does this mean bonds entirely are off the table, or just means that gilts are less attractive?
Well, gilts and investment-grade bonds are all pretty expensive, but it's important to say that they may have a place in the portfolio. They still act as a hedge to short-term volatility for equity holdings, which may look more attractive. So they still may have a place, but don't expect them to deliver a positive real return. You're not going to get that from bonds at the current price.
Let's have a look at equities then.
Sure.
FTSE 100 has gone up slightly, between 1% to 2%, led by Aviva, Standard Chartered, Kingfisher. So those financials and indeed house builders that have taken a bit of bashing since Brexit. What does this mean for equity returns?
Well, I think there's a general feeling of relief that the bank is doing something. The question is how efficacious the latest policy is going to be. And really, we would worry not a jot about what's happening over the next couple of days as this news sinks in, but really what's happening over the long term. And over the long term, the moves we've seen today are not going to make much of a difference to returns. There are some equity markets that look good value. We still think the UK looks pretty good value, and certainly elements of the European markets like financials look attractive, but generally asset prices, including equity prices across the globe, are still pretty high.
I think the most important thing to bear in mind is here at Morningstar, we're a real advocate of long-term investing. We're not speculators. Having said that, even over the long term, investors should expect more muted returns from their portfolio, shouldn't they? Although try to ignore all this noise.
Well, that's exactly right. And so the general level of returns has fallen as prices have risen. And so we're not going to get the sort of returns we would think over the next 10 years that you've had over the last 10 years. And so investors need to be thinking carefully about that. But at the same time, look for pockets of value. They will emerge. They're still there. And that can add to returns. But overall, we just need to see this latest effort by the Bank of England as just pulling forward future returns to today, which ultimately is unhelpful for the long-term investor.
Dan, thank you very much.
Cool.
So interest rates have been cut by the Bank of England, but this is just the beginning of central bank action. What's next? Head of Quantitative Research for Fidelity, David Buckle, is up next to explain.
Hello, David.
Hello.
So yesterday we had a rate cut from the Bank of England. I suppose the big question is, what happens next?
Another one. He announced that he was intending to do one more rate cut before the end of the year if economics pan out as he expects, but he did say he was going to stop there. He doesn't believe in negative rates. That doesn't mean the end of accommodation. It probably means more QE programs rather than further rate cuts.
So when you say another rate cut, what are we talking? We're talking 0.1%?
He'll take it just above zero. He won't go exactly to zero, there's technical reasons for that, but we should view it as taking rates to zero.
And he said that he saw under no circumstance would there be a reason to go to negative rates. What makes the UK situation different then from what we see in Japan and in Europe, where they have seen a reason to go negative?
I think that's the exact reason, that he's looking at that situation and says it's damaged the financial system, which is going to damage the economy. Therefore, I don't want to follow suit.
And of course, negative rates are one lever. Rates indeed are one lever, but it wasn't the only thing he did yesterday. He also announced a QE bond buying programme, 60 billion for gilts, 10 billion for corporate bonds. What happens after this load of QE? Do we get more of the same?
If things don't improve, we get more of the same. We've moved into the same situation as all the other central banks around the world. I don't think we should view it as a knee-jerk reaction. This was clearly thought out and planned before Brexit. In my opinion, it's probably an overreaction. It's a lot very quickly, with not many data points to say we need that much at this point.
And in Europe, of course, they have focused more on corporate bond buying. Do you think that's something that we'll see here in the UK, or is this 10 billion going to remain a small portion of a larger QE programme?
Well, it's a difficult one to answer. On the one hand, it is a lot smaller than the European one, but then the UK gilt market, the UK corporate market is a lot smaller, so there will be liquidity issues. On the other hand, Carney himself said he thought that was going to provide more stimulus than the gilt buying programme, and the committee, the Monetary Policy Committee, voted 8-1 for the corporates, but only 6-3 for the gilts. So probably more corporates rather than more gilts.
And you're right about it being a very small market for the corporate bond. I think he said in the press conference yesterday that only 150 issuers were actually good enough quality in order to qualify for this corporate bond buying programme.
Right.
What does it really mean for bondholders then, for bond investors?
Well, it's fantastic news for bond investors, especially corporate bond investors. Not only the Bank of England, you've got the ECB buying them, you've got Bank of Japan with a lot on their balance sheet, you've got the Federal Reserve saying whilst they aren't buying bonds, they're looking out for corporate bond yields as part of their management of monetary policy. So there's a huge safety net for corporate bond investors. So for the investors, it's great news.
And of course, there was one other lever that he used, this funding for lending or term lending.
Yeah.
What exactly is that, and how does that benefit the economy?
Yeah, that shouldn't be viewed as separate from or additional stimulus to the rest of the package. What he said was he wants to ensure that the rate cut finds its way through to you and I in the economy. Because what could happen is, although there's a rate cut at the Bank of England, the banks don't cut rates. This programme was put in place to ensure that the banks do indeed cut rates. And rather unusually in the press conference, he advised the consumers, if your bank isn't cutting rates, change bank, because there's no reason for them not to with this TSF programme in place.
So in the future, we should expect more of the same, good news for bondholders, perhaps not great news for savers?
It's terrible news for savers. And this is why I'm not convinced these programmes are going to work. That the idea being that you cut interest rates, so it forces people to spend rather than save because it's not worth saving so much, but the reverse is happening. Because savers have been penalised for so long, they're forced to save more, save in riskier products, and that is just going to continue on and on and on.
David, thank you very much.
Welcome.
How do you protect your portfolio against rising inflation? Miton Multi-Asset Fund Manager David Jane explains the risks of investing in a rising inflation environment with Emma Wall and how he protects his portfolio.
Hello, David.
Good morning, Emma.
So we've just heard today that inflation has risen to 0.6%. Not as high as we've seen it in the last decade, and still some way off the government's target of 2%. But if you strip out oil and you look at core, it's a bit higher than that, and indeed it's an increase on the last month. And with rates so low, 0.25% at the moment, inflation is a problem for investors. How does that affect how you run multi-asset?
It's been our thesis for perhaps 8 years now that inflation will be much lower than it has been in that longer term history, for much longer than investors think. And even with 0.6%, we're still at the extreme low end of inflation. But as multi-asset investors, we're outcome driven. We must allow for all potential future scenarios around inflation. Although we would broadly say it's going to stay much lower, not get back to that target or even those much higher rates that we can remember from history, we have to allow for the possibility it might come in much higher than our expectations. So within our portfolio, we'll own a broad base of low inflation beneficiaries. But at the other side, we're going to own gold to hedge against that rise in inflation.
Because Norway has got inflation of 4+% at the moment, I think a lot of people are concerned with the oil price beginning to drop out of that deflationary pressure, that we could see inflation go in that direction. And as I said, with rates so low, it means getting a real rate of return, a real rate of income is increasingly difficult.
Indeed. And then broadly, the commodity deflation period of the last 3 or 4 years probably has come to an end now, and broadly we'll be seeing commodity prices in this region as opposed to halving or doubling as we've seen over the last 4 or 5 years. So they're not going to be a deflationary effect. Clearly they're not necessarily going to be an inflationary effect either. But the challenge investors have, as you especially say, particularly on the income side of investing, is how do you find assets that might earn above even these very low rates of inflation?
And I suppose with such a broad spectrum of tools at your disposal with multi-asset, you say for the inflationary quandary, you can use gold as a hedge, and indeed you can have assets that benefit from a low inflation environment. What then would you say are the other big risks to returns at the moment?
Well, clearly, with extreme low rates, the risk is that we're all broadly wrong on that broad lower for longer scenario, and the inflation comes in very strongly, rates go up broadly across the world. That's one risk. The other risk that you could focus on is, are the prices of all assets driven up by the QE, the government intervention, and therefore do central banks lose credibility? If you buy the first argument, that the price of all other assets is inflated artificially by government intervention over and beyond fixed income markets, and the credibility fails, there is a risk of a broad-based sell-off in asset classes. I think you can challenge both those theses, actually. I don't necessarily think the valuation of equities is broadly outside long-term bounds, notwithstanding the intervention by policymakers. The main distortions appear to be in fixed income.
And how do you tackle that then as a multi-asset investor? Is it about going bottom up and finding quality individual investments that perhaps will benefit regardless of the macro backdrop, or is it very much about playing those macro themes?
In our strategy, it has to be both. We have to have a broadly well-diversified portfolio with assets and asset classes that are independent of the intervention, so we can diversify globally. Clearly the US is no longer embarking on QE. Clearly the emerging markets never have, so those areas you could say are broadly immunised from that feature. But again, as you say, you can go micro and thematic, and you can say these asset classes are set to grow anyway. A nice little example might be consumers in emerging markets. There are more of them, they have more income, or perhaps the change in our energy infrastructure, the new energy economy, that will be growing anyway, irrespective of QE and broadly irrespective of the short-term macro environment.
David, thank you very much.
Thank you.
Up next, J.O. Hambro's Ben Leyland explains how quantitative easing has made quality stocks expensive and warns investors they should prepare for a correction in the next 3 years.
Hello, Ben.
Hello.
So global by name, but by nature, a real bias towards developed markets at the moment. Why is that?
The main reason is that's where the valuation opportunities are. We scour the world for the best value available with a quality threshold to make sure we're investing in things that we can have long-term conviction in. And we simply invest the capital of the fund where the best value is, and that happens to be particularly in pan-Europe at the moment. The other thing I'd emphasise is that we have a lot of emerging market facing companies within the multinationals that we own. So we've never seen geographic listing as particularly relevant to the economic case that we're making for a stock.
That sounds like you're very bottom up then as a fund manager. Do you think about a macro overlay? Are there particular themes going on in the world where you think that's a great opportunity or that's something I really need to avoid?
I would say we would use macroeconomic weakness to our advantage by buying great franchises when they're going through a period of difficulty. We're much more likely to do that than we are to chase some cyclicals in a strong phase of the cycle. So the macro view currently would be we're in a prolonged period of weakness, which we're using to pick up certain cyclical companies like US railroads, for example, which are going through a period of negative volumes.
Because, of course, some of the areas that you are invested in the UK, in Japan, and indeed in Europe, the macro backdrop is a lot of stimulus in those areas. Has that helped the fund so far make rallies, or will it indeed help further?
My view is the stimulus has helped asset prices rise rather than economies recover.
Yeah.
I would say we have benefited to a degree from that, because the stocks that have benefited most are the quality areas of the market which we like to buy, with recurring revenues, bond-like cash flows, and a degree of yield. That's creating problems for us now, because the valuations of such assets are becoming stretched, and we're becoming uncomfortable with those valuations. And so we're having to look at slightly less advantaged sectors and companies.
And these are the stocks which some people call bond proxies, aren't they? They're high-quality, income-paying stocks that have, as you say, had such demand because, bond yields have been so incredibly low, that actually the price of these stocks have been pushed up considerably.
Yeah, the distinction we're trying to draw is between bond proxies and compounders. Both are types of companies which generate cash in a reliable way, but bond proxies pay most of that cash back to shareholders as a yield, whereas compounders have the opportunity to reinvest in high return activities to create more value. And my view would be, at some stage in the next 3 years, we will have a market-wide de-rating. When and how, I've no idea. But you need to be invested in companies which have created value and grown under the bonnet, so that your capital return, your total return is acceptable.
Are there particular sectors which lend themselves more to these new opportunities?
I'm not sure I would emphasise any particular sector. Clearly, I think the bond proxies are concentrated in certain sectors, the staples, healthcare, and to a degree, a lesser extent, the utilities and telco sectors would all be the more defensive, more reliable, cash generative sectors of the market. When we're looking for growth opportunities in compounders, we can find them in any sector, be that industrials. There are certain energy companies which are investing heavily for growth. There are certain software companies which are doing the same. So we try to be as broad-minded as possible when it comes to the industries that we're looking at.
So prepare for a correction, but focus on quality?
Broadly, yes.
Thank you very much.
With a rising stock market and projected economic growth of 1% for 2017, were initial post-Brexit forecasts overly pessimistic? What impact has Brexit had on investors since? Tom Beckett, Chief Investment Officer for Sigma, is up next to discuss.
Hi, Tom.
Hi, Emma.
So life post-Brexit doesn't seem to be what Project Fear had threatened us with. The FTSE has rallied considerably, and economic growth looks like it may be on track for a 1% GDP expansion next year. So have we dodged the Brexit bullet?
I think it's important you separate the conversation out into two separate parts, because there are very different forces at work. I think let's think about the market reaction first, because markets move much more quickly than an economy, certainly, or that's been my experience of the last dozen years. In terms of the first big shift we saw, that was obviously in the currency, and I think on a trade-weighted basis, the sterling has fallen by about 12% since June 24th, when the decision to leave the EU first came about after the referendum. So obviously that's had a positive translative effect upon UK corporate earnings, given most of the company's earnings in the UK are derived overseas. So we've seen a shift higher in the FTSE 100 in particular, but actually more recently there's been a catch-up trade from lots of domestic companies as well. So I think first of all, talk about the international side of things. Clearly there's been an improvement in earnings there, which has been translated into better stock performance. And the domestic side, I think, is probably second-guessing to a certain extent your question about the economy. Are things next year going to be less bad, in inverted commas, than people were first forecasting after the Brexit news came through? I think it's far too early to tell, I think, in all honesty. I think some of the data we've seen so far has been somewhat ambiguous. So certainly on one side we've seen a situation whereby business confidence has fallen. On the flip side of things like retail sales hold up quite well. Now whether that's because the sun is shining outside remains to be seen. I think with regards to the economic understanding and the answers to the questions you've got, let's wait until we
we get into the start of 2017. My view is still for really quite low growth in the UK as we head into 2017 and the possibility perhaps of a technical recession.
And that too early to tell accusation is one that was levied at the Bank of England with its QE programme. The fact that we are committed to buying £70 billion worth of bonds and indeed, lowering interest rates even further, perhaps down to 0.1% next month. Do you think they acted too soon? And indeed, as you say, the truth is yet to out.
I think actually it was just positive to see Mark Carney finally do something and earn the millions of pounds that we're paying him to look after the Bank of England. Let's just take the three things that they announced in isolation and then put them back together, what it means for the UK economy. First of all, with regards to interest rates, I think they're pushing on a piece of string, to quote Mr. Keynes. I can't see that that's going to have any positive effect whatsoever. And actually, for choice, I would say that lowering interest rates has a negative effect upon the economy, because I think we've gone past the point of equilibrium where it continues to be a positive. Secondly, with regards to the quantitative easing programme, okay, but I've seen no evidence from the last decade or the last 9 years we've been trying such policies that it's really worked that well anyway, so I'm sceptical of that, and I think actually it's just made expensive investments yet more expensive and brought forward future returns into the now for stressed investors. I think finally, with regards to what's been titled the Funding for Lending Scheme 2, okay, fine, let's try and encourage the banks to lend, but I think the penalties for not lending are less penal than the first announcement of funding for lending from a few years ago. And I think the second point to take into account is banks are awash with liquidity. Liquidity is not the problem. Banks have got money to lend. They can't lend it to the people they want to lend it to because they don't want to borrow. So I don't think that's necessarily going to help. So I think I'm afraid to say that monetary policy's ability to shelve off the worst or put off the worst forms of economic regression, I think are somewhat limited, and I don't think that's going to be a huge factor as we head into next year.
So heading into next year then, with that uncertainty still around, as we do not know the true impact of Brexit, and perhaps central bank policy is not effective, what does this actually mean for investors?
I think it makes it a very difficult environment to invest because, if you think back to previous episodes when you had expensive equity markets, at least you could go into fixed interest investments and still achieve a return. Now that's impossible. And I've just come from our latest investment committee meeting, and I was questioned on my views that equity markets around the world strike me as being expensive for low rates of earnings growth. But as people quite rightly question, whereabouts are you going to put the money? You can only have a certain amount in emerging market equities or emerging market debt which look attractive, or elements of high yield corporate credit look attractive. Really equities are going to remain a high weighting in people's portfolios because of the paucity of options elsewhere. So I can sit here and tell everyone that equity markets are expensive till I'm blue in the face, but as we've seen from the last couple of months, in particular an acceleration post-Brexit, because of the fall we've seen in government bond yields, I think equity markets can continue to defy gravity, and I think that the whole concept of equities investment almost has to be turned on its head, because I think people are now looking at equities less as equities and for their growth, and more actually like corporate bonds because of the income you can get. So effectively corporate bonds have now equities have now become almost corporate bonds, but certainly a spread product. How much extra yield can I achieve over cash deposits and indeed government securities?
Tom, thank you very much.
My pleasure.
Falling interest rates are hitting your pension income. If you think annuity rates are bad now, wait until the Bank of England cuts rates further next month. Reconsider what your retirement income options are in this current environment.
Earlier this month, Mark Carney and the rest of the Monetary Policy Committee of the Bank of England voted to lower interest rates to 0.25%. This was a long time coming, this change. However, not the way that people were expecting. This was supposed to be the year that interest rates rose for the first time in 7 years. With interest rates falling and expected to fall even further next month, perhaps down to 0.1%, it also means that bond yields across the board have fallen, including gilt yields. The 15-year gilt yield is now 1.14%. It was 2.2% earlier this year. Why should we care about the 15-year gilt yield? Well, this is the yield on which annuity rates are based. Of course, it's no longer compulsory to buy an annuity, but they remain the only product on the market which guarantees you an income for life in retirement. They didn't look very attractive at 2.2, but they look even less attractive at 1.14. We advocate at Morningstar a portfolio approach to retirement investing. Of course, you are free to look into the open market, do DIY investing, consult an advisor, whatever is best for you. But remember, the only way to guarantee an income for life, even if it's just for those essential expenditures, is through an annuity. Annuity rates will rise. It's the time frame that's unsure. So if you can afford to wait to put off that annuity purchase, do so. Otherwise, you might want to consider what the future annuity rates will look like when they lower base rate to 0.1%.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.